Okay, let's unpack this. For you, the global citizen, maybe you're a digital nomad, an expat, long-term traveler, understanding U.S. citizenship-based taxation is really key.
Absolutely crucial.
And today we're doing a deep dive into two specific things that cause a lot of confusion: FBAR and FATCA.
Right.
Our goal here is just to clarify these complex informational reports. It's important to stress these aren't taxes themselves.
No, not tax.
They're tools, really, tools to combat financial crime, that's FBAR, from the Bank Secrecy Act back in 1970, and tax evasion, which is where FATCA comes in, enacted in 2010.
And what's really fascinating here, I think, is how FATCA basically reshaped the whole global financial scene. It essentially made foreign banks, foreign financial institutions everywhere, report on U.S. persons' accounts directly to the IRS.
Directly, wow.
Yeah, so it creates this powerful cross-check system. The government, they often know about your foreign accounts before you even file your return.
Okay, that really changes the game then.
It makes non-compliance, let's just say, a very high-risk proposition.
That's a critical point. Okay, so let's break down the key differences then, what you need to know. Starting with FBR, FinCEN, Form 114.
Right. FBAR, first thing, filed separately. It goes to FinCEN, which is part of the Treasury, not the IRS itself.
Okay, not with the tax return.
Correct. And the trigger is, well, pretty broad. If the combined highest balance of all your foreign financial accounts,
Like bank accounts,
securities, mutual funds, even cash value insurance or annuities, if the total hits over $10,000 at any point in the year,
any single day.
any day,
Yeah.
then you have to report all of those accounts.
All of them, even the small ones.
Yes. You sum the peak value each account reached during the year. If that total number tops 10 grand, every single account gets listed on the FBAR.
And for converting currency.
Yeah, yes, good point.
Wait,
Always use the Treasury Department's official December 31st exchange rate for that year.
got it. Okay, so that's FBR. Moving on to FATCA, that's IRS Form 8938.
Exactly. And this one is filed with the IRS. It actually gets attached right to your Form 1040, your annual income tax return.
Okay, so part of the tax filing process.
Right. And the thresholds are different, generally higher than FBAR. They vary based on your filing status and, importantly, whether you live in the U.S. or abroad.
Like, what are the typical amounts?
Well, for folks living stateside, it often starts around $50,000 in assets. But for expats living outside the U.S., it can be much higher, like $200,000 to start.
And FESA looks at a broader range of assets, too.
It does. It covers specified foreign financial assets. That includes the usual accounts, sure, but also things FBAR doesn't, like maybe foreign stock you hold directly, not in an account, or interests in foreign entities.
So, like, if I set up a foreign LLC to hold, say, a rental property abroad.
Precisely. You'd report your interest in that LLC on Form 8938, not the property itself directly. It's designed to capture a wider net of assets.
Okay, now here's where it gets really interesting and kind of confusing. Cryptocurrency. How does that fit into FBR and FASA right now? It feels like a moving target.
It absolutely is an evolving area. For FBAR, the current guidance says if a foreign account holds only virtual currency, it's, believe it or not reportable right now.
Only crypto. Okay.
But FinCEN has stated they plan to change that. And crucially, if an account holds both regular money and crypto, then the crypto value is included when you figure out that maximum value for the $10,000 FBAR threshold.
Ah, okay. That's a key distinction. And for FAXA?
For FAXA, well, the IRS hasn't given super explicit crypto guidance yet. But given how broad the term specified foreign financial assets is, it's probably wisest to assume crypto held on a foreign exchange, or maybe in a wallet managed by a foreign company, is reportable. Better safe than sorry there.
Prudence seems key. So this leads to the next question. What if someone hasn't been filing these? What are the consequences? I hear the penalties can be pretty steep.
They can be severe, yes. For FBAR, if it's non-willful, you just didn't know, the penalty can be up to $10,000. Importantly, that's per form, not per account. That came out of the Bittner Supreme Court case.
Okay, per year, basically.
Per year's form, yes. But if the IRS determines it was willful noncompliance, then it jumps significantly. It could be the greater of $100,000, or 50%, that's 50% of the highest aggregate balance in the accounts during the year.
50%, wow.
Per year. Plus potential criminal penalties on top of that.
Okay, and for FATCA, Form 8938.
Similar idea, serious penalties. There's a baseline $1,000 penalty for failure to file. If you ignore IRS notices, that can go up to $60,000. And if you underpaid tax because of those undisclosed assets, there's potentially a 40% accuracy-related penalty on that underpayment. Criminal charges are also possible.
That's definitely a strong incentive to get it right. But what about people who maybe just fell behind unintentionally? Is there any way to catch up without facing those massive penalties?
Thankfully, yes. For non-willful situations, there's the IRS streamlined filing compliance procedures. It's essentially an amnesty program.
Okay, how does that work?
You file the last 3 years of missed or amended tax returns and the last 6 years of FBARs. The key part is submitting Form 14653, which is a detailed statement explaining why your failure to file was non-willful. You need to be thorough and truthful.
And if the IRS accepts your explanation?
If they accept it as non-willful, generally all those penalties we just talked about are waived. It's a really valuable program for people who made honest mistakes.
That sounds like a crucial lifeline. So looking ahead, what's the best way to just stay out of trouble? What should listeners be doing proactively?
Record keeping. Simple as that, but absolutely vital. Be meticulous. Keep your FBAR records for at least 5 years. For FC and your general tax stuff, keep records for at least 3 years. Probably safer to go with 6.
What kind of records specifically?
All your foreign account statements. Document the highest balance each account hit during the year. And make sure you note which Treasury exchange rate you used for your conversions, the December 31st one. Good records are truly your best defense if the IRS ever asks questions.
Makes sense. Organized records equal less stress later on.
Exactly.
So at the end of the day, these rules, FBAR, FATCA, they shouldn't feel like a barrier stopping you from living globally, right?
No, not at all. Think of it more as just a manageable part of your financial responsibilities when you have international connections.
So the final thought here might be, invest the time now to really understand these obligations. Move past the uncertainty, That way you can actually achieve that peace of mind and financial freedom to really embrace your global life fully.